Imagine that tomorrow morning, BYD officially launches across the United States. Showrooms open in Los Angeles, Houston, and Atlanta. Prices hit the internet. And within hours, five of the biggest names in the auto industry are on the phone with their strategy teams asking the same question. How fast can we respond? Which American and global automakers would feel the pressure first, and why? BYD is not a scrappy startup hoping to break in. It is already the largest seller of electric and plug-in hybrid vehicles on the planet, having overtaken Tesla in total EV and hybrid sales back in 2023, and continued extending that lead since. It builds its own batteries. It builds its own semiconductors. It even owns the ships that carry its cars across oceans. That kind of vertical integration is rare in this industry, and it changes the math on what a car can cost to produce. Most automakers buy batteries from outside suppliers, negotiate chip contracts years in advance, and lease cargo space on container ships they don't control. Every one of those steps adds a middleman, and every middleman adds cost. BYD skips most of that. Its blade battery technology is built in-house and tuned specifically for its own vehicle platforms, which means fewer compromises and fewer markups passed down the supply chain. When a company controls that much of its own production, from raw lithium processing to the finished vehicle rolling off a car carrier it owns, it can price aggressively without bleeding money the way a traditional automaker would at the same sticker price. That's the real story here. Not politics, manufacturing. This matters because the American auto industry has spent the last decade competing mostly against itself. Detroit versus Detroit, Detroit versus Germany, Detroit versus a handful of import brands that all source parts through roughly similar supply chains. A company with a structurally different cost base doesn't play by those same rules. And that's precisely what makes this hypothetical worth taking seriously. So who gets hit first if that machine starts operating on American soil? Start with Tesla, because the comparison is unavoidable. Tesla built the modern EV market and still commands the strongest brand loyalty in the segment, along with a charging network that competitors are now paying to access. But Tesla's pricing has already been sliding for years, a sign that margin pressure is real even without BYD in the picture. If a company known for building comparably equipped electric vehicles at a noticeably lower price point entered the market, Tesla wouldn't lose its identity overnight. What it would lose is room to maneuver on price. Expect a harder push into software differentiation, since full self-driving subscriptions and over-the-air features are margin Tesla can control that a hardware competitor can't easily copy. Expect faster iteration on the Model 3 and Model Y platforms, and expect the supercharger network to become an even bigger bargaining chip, especially as other automakers plug into it. Tesla's advantage was never just the car, it's the ecosystem around it, and that's the part BYD would need years to replicate, not months. Ford is a different story, and arguably a more exposed one. Ford has poured billions into its electric lineup, and it has been candid, sometimes painfully so, about how much money it's losing on every EV it sells. That's not a company with room to absorb new price competition. It's a company already trying to figure out how to make electric vehicles profitable at all. A low-cost, high-efficiency competitor entering the mainstream segment doesn't just threaten Ford's EV ambitions. It threatens the timeline Ford has set for getting those ambitions to break even. The likely response? Expect Ford to lean harder into what it already does well: trucks, hybrids, and its commercial fleet business, while quietly recalibrating how fast it chases EV volume versus EV profitability. Efficiency, not just innovation, becomes the priority. Then there's General Motors, and specifically Chevrolet, which has built its entire modern identity around being the affordable, accessible option. The Chevy Equinox, EV, and Bolt were explicitly positioned to bring EV ownership to buyers who couldn't stomach a Tesla price tag. That positioning only works if Chevrolet remains the cheapest credible option on the lot. If BYD entered offering similarly equipped vehicles at a meaningfully lower price, Chevrolet's entire value proposition gets squeezed from underneath. GM's advantage is scale, and an existing dealer network that spans small towns BYD would take years to reach. Expect GM to double down on that distribution advantage and to accelerate cost-cutting in battery production through its Ultium platform, because the fastest way to defend a price-sensitive customer base is to lower your own floor before someone else does it for you. Nissan's situation is almost bittersweet. This is the company that pioneered mainstream EVs with the Leaf back in 2010, years before most competitors took electric seriously. But that early lead has eroded. The Leaf's technology has aged relative to newer entrants, and Nissan has struggled financially in ways that limit how aggressively it can reinvest. A well-capitalized, high-efficiency competitor entering the affordable EV space is exactly the kind of pressure a company in Nissan's position can least afford. The realistic response involves partnerships. Nissan is already part of an alliance with Renault and Mitsubishi, and shared platforms, shared battery sourcing, and shared R&D costs become less optional and more essential when a competitor can undercut you on price while matching you on features. Hyundai and Kia present the most interesting case because on paper they look the most prepared. The Ioniq 5, the Ioniq 6, the EV6, these are vehicles that have won awards and earned genuine praise for design and technology. Hyundai's eGMP platform is modern and flexible, but strong products don't cancel out a wide price gap. Hyundai and Kia compete heavily on value already, which means they have less pricing room to give up than a luxury-leaning brand would. Their most likely move is to accelerate what they've already started, building batteries closer to home through joint ventures like the one with LG in Georgia, and pushing harder into lower trims of existing models rather than only chasing flagship technology. Reducing exposure to global supply chains becomes a defensive necessity, not just a manufacturing preference. Widen the lens for a moment. 5 companies, 5 different playbooks, but one underlying pressure. That's really what this is. Prices across multiple segments would likely face downward pressure, not because every automaker panics, but because pricing is relative. When one credible option resets what affordable EV means, everyone selling in that space has to respond, whether through discounts, incentives, or new lower trim models built specifically to compete. Consumers would likely benefit from more choice and sharper pricing in the short term. Automakers would face a harder question: compete on price and squeeze margins further, or compete on differentiation and pour money into R&D they may not have room for while their existing EV lineups still aren't profitable. There's a version of this story where American automakers come out stronger for it. Competition has a way of forcing discipline that comfort never does. Toyota didn't build its reputation for reliability because nobody was watching. It built it because Japanese and American rivals were breathing down its neck for decades. The same forcing function could apply here, pushing Ford toward faster cost discipline, pushing GM toward cheaper battery chemistry, pushing Hyundai and Kia to localize supply chains they've already started building. Pressure doesn't have to mean decline. Sometimes it's the only thing that gets a bloated cost structure fixed. None of this guarantees winners or losers. Industries rarely move in straight lines, and every company mentioned here has assets BYD doesn't. Brand history, dealer networks, domestic manufacturing incentives, and in some cases, decades of trust built with American buyers. Efficiency alone doesn't buy loyalty, but it does buy leverage, and leverage has a way of forcing everyone else's hand. So here's the real question worth sitting with. If one company can build high-quality electric vehicles at dramatically lower costs, will the future of this industry belong to whoever invents the best technology, or to whoever learns to manufacture it most efficiently? That's not a question with an easy answer, and maybe it shouldn't be. Drop your take in the comments because this is exactly the kind of shift that gets decided by which side turns out to be right.